This is the Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday, July 11th show. Each week I'm sharing expert advice and inside knowledge on how today's events in our local economy can affect your money. If you're listening or hearing my show at a different time or day, you are listening to a rebroadcast, but you can call into the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com to ask any questions or for me to connect you with the guests that I have in studio right now. And in studio, I'm going to be talking with Kyle Schultz with 360 Credit Consulting. With so many credit repair companies out there and the lack of sites willing to bring you the real story on credit repair, I have Kyle, that is my expert, to share everything regarding credit. And there's a lot that you can do, Kyle, with consumers to help them get their credit scores in a better position that can make a huge impact on the overall interest and cost that they're paying on anything that they're borrowing.
Absolutely.
Yeah, so it's always exciting to have Kyle here. Kyle is a FICO certified credit expert that has been helping people restore their financial freedom for years. So Kyle, let's go ahead and start out with a credit score and sharing with my listeners what it's made of.
Well, there's a couple of different things that go into credit. There's a couple of sections that are all kind of co-dependent on one another, that you can do something really well in this section that, should give you a lot of points over here, but it could unfortunately hurt you over here. For instance, one of the sections is payment history. It accounts for 35% of your score. In that section, it's basically looking at your history of payments on your homes, your autos, your student loans, credit cards, etc. But it's also the same section where every single negative account is found. So even though you could be doing something really well in that section, paying everything on time, if you have one collection that you didn't pay from 3-4 years ago, it can unfortunately drop your score in that section. So it could get a whole lot more complicated than that, basically.
It does get a lot more complicated, but we're kind of just covering some of the tips here today, and that's why you have a credit expert, because I hear people say all the time how, I can do that myself, and you really can't. I mean, you can, but not to the extent that you can with a professional and a professional company that really understands how the credit bureaus work and really some of the violations that are against you based on the Fair Credit Reporting Act. So what are 3 things that my listeners should focus on regarding credit, if we're just to break out 3 of them right here today?
By far, number 1 is making every single payment on time.
Okay,
if you
makes
miss
sense.
one payment, or God forbid, if you roll late for 30, 60, 90 days, it will be very detrimental to your score. So you want to make sure you're paying everything on time. And then your utilization of credit cards is probably the next most important. So if you have one of those credit cards, you really want to make sure that you're not maxing it out or going above the acceptable percentage of debt to limit ratio. The sweet spot on where you want to be is 25 to 30% on each one of your cards. If you can
definitely
have it,
not over 50.
Definitely not over 50. If you go over 50, that's where you're going to have a major point loss. But if you can get it back under 50, you'll get a lot of those points back. But lower the better. So if you can pay them down to 5% a month, do that. And then the third thing that I would say is probably the most important is keeping an eye on what accounts you have open and that you're closing at any given time. So, I have a lot of clients that have a account from, 1976, an old, JCPenney card, and they're like, I don't even shop there anymore. I'm going to close it. No, don't do that. You really want to keep a good eye on that, because it's another section that is worth a lot of points. So.
And that is such a huge tips. And I want to just recap these because they're so important. Obviously, everybody knows to pay their bills on time, but I think sometimes people are like, you know what, I that was not my wrong. I shouldn't have to pay that. The bottom line, it's not hurting anybody except for yourself. So you want to make sure that you get over that pride part of it and just do what you need to do to make sure things don't come in late. And the ratio thing is a big thing, but I will say that that's one thing that you can actually fix. So the best thing with your mortgage consultant and why you want to work with a professional on the mortgage side is the rapid rescore ability to look at a credit report and go, you know what, here's exactly what I need you to do some temporary or to do a quick fix, not going to the credit repair process, but just a quick fix. And that's getting those percentages down. Now, what Kyle's talking about is your revolving credit card. And some people think it's per card, but it's the entire revolving amount of cards altogether. Is that correct?
Yes, ma'am.
And so really just being able to minimize that. So if you pay your bills on your credit card, let's just say you have one credit card and you pay your bills every single month on it, that's great. But the problem is you don't know when that's going to actually be reporting. So you want to make sure you keep it under that sweet spot. And the last thing Kyle mentioned, which is so huge, because I can't tell you how many times that I've had people come in and have devastating credit scores because of the fact they closed accounts out. Now, unfortunately, unlike the use of your account, once you've done this, you can't fix it. You can't go back and reestablish that, correct?
No, you cannot. Once you close that account, it's gone. A lot of people
You got to go to your parents and ask them to get on their old JCPenney's credit card, right?
Exactly. The unfortunate thing is once it's closed, it's gone. And they will also close accounts just for inactivity. So if you have a card that you haven't used in, usually it's over 12 months, they can close that account on their side.
I didn't realize that.
Yeah.
Wow. So that's a new tip for me. So you want to put some type of purchase on it for these older accounts.
Exactly. For instance, I have a Yamaha credit card that I used to buy my first motorcycle.
Okay.
And I will never have a Yamaha again, but it's my oldest account. And so once a year I go into that dealership and I buy, a pair of gloves or something like that just to keep that account open and active. That way I can keep that history.
Yeah, great tip. So let's talk about credit score. Will you give my listeners the bracket and really kind of what you would range in a good credit score?
Well, the credit scores in each industry are different. There's a different range. In the mortgage industry, it ranges from 300 to 850. As far as what people will be, talking about as having a good credit score, anything in the 600s or above is typically where you would want to be to get a mortgage. You correct me if I'm wrong, but like 640 is typically that sweet spot for getting a mortgage.
Yeah, there's options there at 580 with government, and there's some 620. But
that's why she's a mortgage expert.
You'll have some challenge, a little bit addition to the interest rates, and not the best programs definitely when you're in that bracket. But
really, 720 is like the all-out bragging rights. If you have 720, then you're going to have the lowest interest rates on anything you can purchase in any industry. Anything above that is just, the cherry on top. So
yeah, so if you, exactly. Sometimes people are like, well, I have an 850. It really doesn't matter. You're on the highest credit bracket, so you're all good.
Yeah.
Now, how do credit cards impact your score?
Well, the first thing that you got to keep in mind with credit cards is you have to have one, folks. If you don't have a credit card, you're missing out on 30% of your possible points. Yep. And those are points that you need to get that mortgage or that car loan or, be able to qualify for that job, like you said earlier. So you got to make sure you have one. If you don't have one, then you got to get one anyways, regardless of how, good or bad your credit is. So a secured card would be a good route to go. The only thing that I'll say there is you want to make sure that you get a secured card that does report to all three bureaus. A lot of these smaller mom, pa, banks and credit unions don't actually report because legally they don't have to, and it does cost them money.
Yes.
So just make sure that you ask those questions on whether or not they're reporting to the bureaus, and if so, are they reporting to all three or just one or two? Make sure you're doing that. And then like we already talked about, your balance to limit ratio. You really got to make sure that that's where it needs to be, 25 to 30%. And then you got to make sure that they're reporting accurately. So there's lots of instances where, I'm looking at a credit report, I'm sure you've seen the same thing, where you'll see a limit of, 1296 or 1407 or, 851. Probably not. It's probably $1,000, $1,500, or $2,000. And for whatever reason, it's just reporting inaccurately.
Yes.
Somebody, fudged the numbers somewhere. And so that can cause you to have a lower, debt or a higher debt to limit ratio.
Yep.
And so you want to make sure that you get those limits reassessed.
And when you're talking about credit card having one, it's because there's a percentage that is based on the, what do they call that? The different types of credit that you have.
Exactly.
And isn't there a sweet ratio as well as far as how many revolving versus installment that you have? That's that 3-to-1 type thing, or?
Yeah. Well,
I pretend like I'm a credit expert. I know I'm not, but what is that? What is that ratio?
It's that section specifically is called types of credit used. It accounts for 10% of your score. And what they're looking for in that section, or I guess not looking for, is that you have a home, car loan, and 20 credit cards. Instead, they want to see that you're more well-rounded. So the rule of thumb is that you have one revolving per installment. That's it. So if you have a house, you have a credit card. If you have a car, you have a credit card. That's it.
Got it.
And so, unfortunately, a lot of people in this country don't live by that. I mean, heck, I'm the credit guy, and I don't live by that.
So the 3-to-1 was wrong. Don't listen to me. Listen to Kyle. It's 1-to-1, not 3-to-1.
1-to-1. Yeah. And so you want to make sure that you just have a balance there.
Makes sense.
Yeah.
So let's just give an overview to my listeners on what credit repair is.
Credit repair is the process of taking a client with that less than perfect credit and rehabilitating them to be able to get them into that, mortgage or car loan, or basically to help them achieve whatever goal they're trying to achieve. And there's lots of different ways that you can go about doing that.
And I have clients that I send to your company all the time, Kyle, when I run into them. And I want you to explain a little bit about what you guys do differently from your clients than your typical credit repair company.
Well, the first thing that we do is really listen and take the time to understand that every client is different. I mean, they're all like snowflakes. There's no two clients that are the same, and every situation does matter because that situation is how you're going to be able to figure out how to get them out of it. So,
Yes.
Taking the time to listen is really important. We give a free consultation where we'll go through the whole credit report with the client, make sure they understand everything that's on it, how they got in their situation, how they can get out of it, and how they can make sure it never happens again. And then if at that time it's a good fit on both parties' behalf, then we'll enroll you into the program where we'll teach and educate you, which is really important. There's no class in high school or college that teaches you how to have a good credit score. And so 65% of your score is based on that good credit. So we're going to show you what accounts you need to open, what accounts you need to close, redistribution of any debt that you might have to where it is the most favorable on the report that it can be. And so that's Avenue 1 is what I like to call it. And then Avenue 2 is where we work on your client's behalf with the credit bureaus to remove any and all derogatory information, such as those collections.
I think that's really key for a listener to understand. It's kind of like getting a speeding ticket when you were speeding, but you hired an attorney, and the attorney kind of looks at everything and makes sure that your rights were not violated. 70% of the time they are, and I think there's a statistic around there in your arena as well that somewhere around that 70%, there's some type of violation on the credit report. You may have made that late payment. That's not what it's about. What it's about is how it's getting reported on your credit report, which is out of your right as a consumer. And that's where you guys come in and can have some magical effects on credit score. And I want to talk about timing, and I want to set you up as a listener. You need to do this right now. Get in, find out what your credit score is, where you're at, and get some advice on what you need to do before you're thinking about buying a home, because it takes time to go through this process. And so the last thing you want to do is get excited and step ahead, get your credit lined up, and get it in a position that you can be a homeowner. What is that typical time, Kyle?
On how long it takes from
start from finish?
We average internally at my firm roughly between 90 and 120 days. It is different depending on the companies that you go with. I mean, obviously, we're all in it to make money, and so some people will choose to drag that process out a little bit longer than they need to, in my opinion. But any of the good companies would probably get you in and out within 90 to 120 days. Yep,
totally agree. Really quick, I got to take us to commercial, Kyle. I want you to break down the cost with it, because it's unbelievable how realistic it is to cost, especially working with you guys. Can you share that?
Yeah, absolutely. So the average cost for my services in this country right now is between $700 and $1,000 per person, which I don't know about you. I don't have that kind of money to throw away on credit repair. So my company and other companies that are also worth your time in business are charging roughly around, an $89 to, $100 enrollment fee, and then roughly, $50, $60 a month, somewhere around there.
Unbelievable.
So if they're charging exorbitant upfront fees, run.
Yep. And it's huge impact that this is going to have on everything regarding your life. Unfortunately, or fortunate, however you want to look at it, your credit really is going to make or break your financial situation on everything that you do. Kyle, thank you so much for coming into studio. It's always a pleasure to sit across the table and talk with you. And I appreciate everything you do for my own personal mortgage clients as well. So thank you.
Thank you, Tina.
Coming up next in the Money Hour, how do you get top dollar for your house? Create an interactive online 3D model of your home and other structures. Sounds pretty cool. Well, I've got Mark Tillman and Kathy Oman with 3D4RE right here on 1150 AM KKNW after the short break.